Welcome, everyone. I am absolutely thrilled to have you here for today's explainer. We're taking a deep dive into the fascinating, behind-the-scenes economics of India's Unified Payments Interface, better known as UPI. We all use it, we all love it, but the financial machinery powering the world's most active real-time payment platform is full of surprising twists and hidden mechanics. Get ready, because we're going to uncover exactly how this massive digital ecosystem actually sustains itself.
Okay, let's dive right into this. 1,500 crores. That is the staggering net profit the National Payments Corporation of India, or NPCI, made in the 2024 to 2025 financial year alone. Just to put that into perspective, their profit margins were above 50%. It's an absolute financial success story for an entity that provides a service most of us don't directly pay a single dime for.
Which leads us directly to the central mystery of today's explainer. Seriously, how does a completely free payment system make billions of rupees in profit? NPCI handles a breathtaking 46% of the world's digital transactions. UPI alone processes over 3,700 transactions every single second. Yet for the vast majority of users, it costs absolutely nothing. So where is all this money coming from, and how are they so incredibly profitable?
Well, to answer that, we really have to look at their wildly efficient financials. Out of roughly 4,000 crores in total revenue, NPCI spent just 210 crores on technology and 290 crores in appreciation. When you add that up, it only costs around 500 crores to run the entire switch layer for UPI and other legacy payment systems. Think about that for a second. That is basically the entire country's payment infrastructure being run on a budget that is almost miraculously lean. And when we break that extreme scale down, the efficiency becomes even more mind-blowing. In the 2025 financial year, NPCI processed 213 billion transactions. If you take that 500 crore technology spend and divide it by those 213 billion transactions, the cost comes down to an extraordinarily low 0.023 paise per transaction. That's not 23 paise, folks. That is fractions of a single paise to instantly move money across the country.
But, here is where the plot thickens. While NPCI is operating with hyper-efficiency, those fractions of a paise still add up, and running a massive banking network is far from free. Which brings us to a very serious conflict. If you and I aren't paying for these daily transactions, who is actually picking up the tab for this monumental infrastructure?
Now, what's really fascinating here is the sheer scale of this financial gap. Under the government's zero merchant discount rate, or zero MDR mandate, banks process all these transactions for free. It's estimated that banks face an industry revenue loss of 10,000 to 12,000 crores annually because of this. On the flip side, the government provided a budgetary subsidy of just around 1,500 crores to offset that loss. That leaves banks staring at a massive, near impossible financial deficit. So how in the world do banks survive this? To figure that out, we're going to turn to a massive 12-year empirical study published in March 2026, which investigated exactly how this digital explosion has fundamentally restructured the revenue models of Indian banks. The researchers actually coined a perfect term for this situation, the volume revenue paradox. Banks are processing a record, historically unprecedented number of digital transactions, all while earning progressively less per transaction under the zero MDR regime. Because they can't charge for UPI directly, banks are effectively cross-subsidizing UPI's operational costs through legacy fees. We're talking about things like minimum balance levies, ATM fees, and checkbook charges. But here is the study's first big revelation. The sheer volume of UPI doesn't actually harm the bank's aggregate non-interest income. They call this the fee neutralization effect. Yes, direct fee income is absolutely lost due to zero MDR, but banks are getting paid in something arguably way more valuable: data and deposits. Because UPI is so incredibly easy to use, more money stays in the banking system, boosting current account and savings account balances. Plus, the massive treasure trove of transaction and merchant relationship data allows them to highly target and cross-sell lucrative credit and insurance products. Let's move to how this builds, because to prove this wasn't just a happy coincidence, researchers ran what are called Granger causality tests.
They really wanted to know, do profitable banks just invest more in digital, or does digital adoption actually cause the profitability? Well, the math proves it's a unidirectional causal effect. An increase in digital payment volume directly causes a reduction in a bank's cost-to-income ratio, which subsequently drives a measurable, real-world improvement in their overall return on assets.
And to show you exactly how precise this impact is, the researchers identified one highly specific, almost magical decimal number, minus 0.042. It looks tiny, right? But the economic impact of this single figure is absolutely massive for the banking sector. Here is what that number actually means. For every 1% rise in digital payment transaction growth, a bank's aggregate cost-to-income ratio is continuously reduced by 0.042 percentage points. This means that even a marginal, tiny digital substitution of manual, paper-based transactions delivers immediate structural operational efficiency for the banks. They're saving big on cash handling, teller time, and physical infrastructure. And this brilliantly illustrates a pretty severe capability gap in the sector. During the UPI era, private sector banks maintained a mean return on assets of 1.41%. Meanwhile, public sector banks sat at just 0.09%. Private banks aggressively leveraged this digital shift to their advantage, while public banks initially struggled, posting years of negative returns before finally beginning to recover. That 1.32 percentage point gap in return on assets, that is quite literally the cost of digital underinvestment. The study concludes that for public sector banks to fully catch up, they can't just focus on standard lending anymore. They require targeted digital capability investments and the creation of dedicated digital revenue units to actively monetize the data flowing through their UPI networks.
Okay, so the banks have figured out how to survive, and even thrive, by indirectly monetizing a free system. But just as we've solved that puzzle, a massive plot twist is emerging. The government is actively looking to change the rules of the game. This brings us to the most pressing question for users today. Will the ecosystem actually stay free forever? To understand where we're heading, we need to look at some recent legislative action. Lawmakers in the Lok Sabha recently cleared a bill amending the Payment and Settlement Systems Act of 2007. The major takeaway from this amendment is that it removes the legal restriction that previously barred banks and payment service providers from collecting merchant discount rates on notified electronic payment modes. And yes, that includes UPI. The rationale behind this legislative shift is really all about long-term survival. As noted in the discussions surrounding the bill, the government intends to create a framework to ensure banks and payment service providers have a sustainable source of revenue. The ultimate goal is to fund the continuous development of this massive ecosystem, fairly distributing the infrastructure cost as UPI transaction values soar into the hundreds of lakhs of crores. So, the crucial point is how this works in practice. These proposed changes will de-link the Payment Act from the Income Tax Act, officially permitting banks to levy an MDR. Current estimates suggest this fee would range from 0.25% to 0.4%. However, to protect everyday users and small merchants, this fee is expected to apply primarily to UPI transactions that exceed 2,000 rupees. Which brings us to our final thought. The introduction of merchant fees on transactions over 2,000 rupees could fundamentally alter the trajectory of the world's most active real-time payment platform. Will it sustain the rapid innovation we've come to rely on, or will it shift consumer and merchant behavior back toward older methods? It's a fascinating balance of economics, technology, and policy. Thank you so much for joining me for this explainer. I hope it brought some incredible clarity to the true cost of our digital wallets. Keep asking questions and keep learning.